Good morning, and thank you for joining us for this webinar. My name is Tom Scott. I'm a member of the International Accounting Standards Board, and I'm joined by Craig Smith from our technical staff. In our last webinar, we gave you an overview of our discussion paper, Business Combinations, Disclosures, Goodwill and Impairment, which the board published in March this year. In this webinar, we will focus on one area of the discussion paper, the board's preliminary views on improving disclosures about acquisitions. So first, some housekeeping. As with all our presentations, any views we express today are our own views, that's Craig and I, and may not necessarily be shared by the board or the IFRS Foundation. You can submit questions during the webinar, and we will answer as many of them as we can at the end of the presentation. The presentation should take about 25 minutes. We've provided some links on the slide to the discussion paper and also to the snapshot, which provides a summary of the discussion paper. So we'll now start with a brief reminder of the background to the discussion paper and what it contains. The board started this project after a post-implementation review of IFRS 3 business combinations. As I mentioned earlier, we published the discussion paper in March this year. The board has requested responses by 31 December 2020. The objective of the project is to improve the information that companies provide to users at a reasonable cost about the businesses those companies buy, helping users hold management to account for acquisition decisions. Slide 5 summarizes the board's preliminary views that are presented in the discussion paper. These cover three main areas: improving disclosure requirements, improving the accounting for goodwill, and other topics. These areas reflect concerns the board has heard from stakeholders. In this webinar, we will focus on the first of these areas, disclosures. There are two strands to the board's work in the area. First, the board's preliminary view is that it should require companies to disclose information about how business combinations perform after the acquisition. Secondly, the board's preliminary views include some ideas for targeted improvements to existing disclosure requirements in IFRS 3. It is perhaps just worth emphasizing here that views in the discussion paper are preliminary. Depending on the feedback and comments that the board receives from outreach and the comment letters, the board may decide to reconsider some or all of these preliminary views. So our first issue on today's agenda is subsequent performance of acquisitions. So let's focus on slide 7. One of the key messages that the board has heard from investors is that companies generally do not disclose sufficient information to allow investors to assess how well a business combination has performed post-acquisition. Investors want this information so they can hold management to account for its decisions to acquire a business. Most investors told us that the information is needed for stewardship purposes to help them, for example, determine whether they can trust management with future capital decisions. Existing standards do not specifically require companies to disclose such information, and hence any information that is provided today is disclosed voluntarily. Therefore, the discussion paper explores whether to require companies to disclose information on the subsequent performance of business combinations. The board's preliminary view is that it should require companies to disclose in the year of acquisition the strategic rationale for the business combination, which links to the company's overall strategy. The key objectives of the business combination, these being aims that are more detailed than the strategic rationale, and the metrics and targets that management will use to assess to what extent those key objectives are being achieved. Then in subsequent periods, the company would disclose the business combination's actual performance based on those metrics to enable users to assess to what extent the key objectives identified at the acquisition date are in fact being achieved. So slide 8 describes the kind of information the board's preliminary views would require companies to provide. The board noted the wide range of reasons for acquisitions and concluded that no single metric would be suitable for every business combination. Therefore, the board is exploring a management approach using the term chief operating decision maker to define management. This term is already used in IFRS 8 operating segments. However, that does not necessarily mean the information the board is looking for companies to disclose in this preliminary view is the information the company discloses applying IFRS 8. In this preliminary view, the board is looking for information that the chief operating decision maker is reviewing about the performance of acquisitions. In IFRS 8, the board's objective is to identify information to assist users to understand the business activities a company engages in as a whole. The management approach has two aspects. First, the management approach helps to identify the acquisitions for which disclosure of this information would be required. Applying the board's preliminary views, a company would need to disclose information for all acquisitions that the chief operating decision maker is monitoring. Second, the CODM approach is used to identify which information needs to be disclosed. A company would be required to disclose the information that the CODM uses to monitor the performance of the acquisition, both in terms of identifying the initial target metrics and the subsequent information on the progress in meeting those targets. Those metrics might be financial or non-financial information. Because acquisitions can often involve large sums of money, the board presumes that most companies are monitoring the subsequent progress of their major acquisitions. But if management is not monitoring a business combination, the board believes that the company should disclose this fact. The board does not propose to prescribe a minimum set of information to be disclosed in such cases. Essentially, the board's preliminary views aim to require companies to disclose the most important information about the most important acquisitions. The board hopes that by using the idea of the chief operating decision maker in this way, it can avoid requiring large volumes of disclosures, particularly for companies that make many acquisitions. The board is particularly interested in hearing feedback on, first, whether investors would find the information provided by the management approach useful, or whether the board should specify some minimum level of metrics that should be disclosed by all companies. Some investors have suggested metrics such as revenue and margin information would be useful for all acquisitions. However, the board's preliminary view is that all acquisitions are different, being completed for different reasons, and so a management approach would provide better information to users. Second, whether stakeholders think that using the chief operating decision maker would set too high a threshold, leading to companies not disclosing material information needed by investors. Alternatively, if the board were to rely on normal materiality judgments, would that result in an overload of disclosures, especially for highly acquisitive companies? So, moving to slide 9, the management approach also determines the period of time for which a company would be required to disclose information about a particular acquisition. The board is aware that information about the subsequent performance of a business combination becomes less relevant over time, and eventually the acquired business becomes indistinguishable from the rest of the business when integration occurs. The board's preliminary view is that companies should continue to provide the information for as long as management continues to monitor whether the acquisition date objectives are being met. However, the board expects management to be aware of how well a business combination is performing, at least for the first few years after the acquisition, and therefore its preliminary view is that companies should provide this information for at least the year of acquisition and the next 2 annual periods. If the company stops monitoring the business combination at any time within this time frame, it would need to disclose the reason for doing so. As noted on the slide, the board also considered what happens if the CODM changes the metric it uses to monitor the performance of the acquisition. This might arise, for example, because the acquirer identifies more accurate information about the acquired business after the acquisition has been completed. If the CODM does change the metric used to monitor the acquisition, the company should disclose the new metric and the reason for the change. So I'm now going to hand over to my colleague, Craig Smith, who will carry on with the presentation.
Yeah, thank you, Tom. So now we're going to go and talk about some of the specific areas of the board's preliminary views. And these include some areas considered by the board discussion paper, as well as some initial feedback that the staff has heard while we've been discussing the discussion paper to date. So one of the most common areas of feedback is that the information about subsequent performance of acquisitions should be in management commentary and not in the financial statements. And that's what slide 11 talks about. Some stakeholders have said that the information, such as strategic rationale, objectives and targets for an acquisition, is strategic information, and that information about the subsequent performance of the acquisition is analysis of performance. They said that both of those types of information should be included in management commentary rather than in the financial statements. Some of those stakeholders looked at the board's conceptual framework, noting that the objective of financial statements is to provide financial information about a company's assets, liabilities, equity, income, and expenses that is useful to users of financial statements in assessing the prospects for future net cash inflows to the company and in assessing management's stewardship of the company's economic resources. Those stakeholders say that the information discussed in the board's preliminary view is management information that is not directly related to the company's assets, liabilities, equity, income, or expenses. Other stakeholders say that the targets and metrics used by management are likely to be so-called non-GAAP measures. Accordingly, those targets are, in their view, better placed in management commentary than in financial statements. Another area of concern is that the information might be considered to be forward-looking, and we'll come back to that topic later. However, we note that disclosing this information in financial statements is not necessarily inconsistent with the conceptual framework. In particular, the information does relate to the assets and liabilities acquired in a business combination, and the prospect of those assets generating future cash flows for the entity. Users tell us that this information is needed for stewardship purposes. We also note that other requirements in IFRS standards already require a company to disclose what could be considered non-GAAP information in financial statements. For example, a company is already required to prepare so-called pro forma information about how much revenue and profit an acquisition would have contributed to the company if the acquisition was at the start of the financial period. If that information was not specifically required by IFRS standards, it would be non-GAAP information. Some companies may include information about the subsequent performance of acquisitions in their management commentary already. However, management commentary is not always available to investors, or it might not be available at the same time as financial statements. The board's practice statement on management commentary is not mandatory. Adding guidance in the practice statement may not therefore be sufficient to encourage more companies to provide investors with information of the kind identified in the board's preliminary views. Investors have said that they're not getting enough information today about the subsequent performance of acquisitions. In reaching its preliminary view, the board put weight on ensuring that the information is made available to all investors. The only mechanism open to the board to mandate the provision of this information is by including a requirement to disclose this information in financial statements. This would ensure that the information investors say they need to assess management stewardship is consistently available. In the board's view, if the information remains something that companies could voluntarily include in management commentary, this would not really change the position that we're in today. Investors would continue not to get enough information about the subsequent performance of acquisitions. If respondents do think that the information is better placed in management commentary, it'd be helpful if they could then explain how they would encourage companies to disclose this information. And if respondents think that companies might be willing to disclose some information in management commentary, but reluctant to disclose that information in financial statements, it would also be helpful to the board if respondents could explain what that information is and why companies would be more willing to disclose that in management commentary rather than in financial statements. So if we move on to slide 12, we're going to come back to forward-looking information. Some stakeholders have told the board that information about management's objectives and targets for an acquisition could be considered forward-looking information in their jurisdiction. But those stakeholders say that this could possibly open the company up to litigation or regulatory risk if targets are not met. In the board's view, the information discussed in the discussion paper is not forward-looking. Information about management's target is just that, it's a target. Targets are not forecasts of what will happen in the future. Instead, a target is a planned amount that management hopes to achieve as a result of undertaking a series of actions. The target represents an amount that, if achieved, would lead to management considering the acquisition to have been a success. In contrast, A forecast is an expectation or a prediction of future performance. The board also notes that the objectives and targets disclosed in applying the board's preliminary views are historic assumptions that management had at the time of acquisition. They're not a prediction of the result management expects to achieve at the time of publishing the annual report. Initial feedback we hear on this topic suggests that concerns about forward-looking information might be specific to particular jurisdictions, for example, because of local legislation. Accordingly, if stakeholders are concerned that the information is forward-looking, it'd be helpful if they could provide some information about how that concern arises. For example, that might include providing details about legislation in that jurisdiction and describing how a company disclosing management's targets at acquisition would be considered to be providing forward-looking information applying that legislation. The board is particularly interested in hearing feedback from regulators on this topic. Slide 13 discusses another topic stakeholders often bring up in discussing these preliminary views, and that's what happens when an acquired business is integrated into the acquirer's business. Some stakeholders say that in this situation, it might be difficult for the acquirer to isolate the performance of the acquired business from the performance of the enlarged group. However, in these circumstances, it might be the case that management intend to monitor the subsequent performance of the acquisition using information about the combined business. And if that is the case, then management would disclose information about the combined business. For example, one objective a company might have in making an acquisition might be to achieve cost synergies. Such synergies typically arise as the result of integrating an acquired business into the existing business, and management might intend to achieve that very soon after the acquisition. In that case, the information disclosed about the achievement of synergies objective is likely to be information about the combined business rather than the individual businesses. In some instances, management might receive internal reports that explain what the information about the combined business signals about the performance of an acquisition. In that case, the board's preliminary view would require a company to disclose this commentary if investors needed to understand whether management's objectives are being met. This is because it's part of the information management is using to monitor the performance of the acquisition. The board assumes that even when an acquired business has been integrated, the acquirer's management understands how the acquisition is performing, at least in the early period. In fact, this might have to be the case where there are clauses in the acquisition agreement that legally oblige companies to measure the subsequent performance of an acquired business. For example, if there's an earn-out clause in the acquisition agreement. In our outreach meetings so far, preparers have sometimes given the initial impression that it's not possible to identify the performance of an acquisition after it has been integrated. However, when we then go on to ask whether that means that management isn't monitoring whether the performance of an acquisition, it often turns out that management do have some means of monitoring the acquisition's performance after integration occurs. This could perhaps be as part of the company's internal control mechanism. It is this information that the board wants companies to share with investors. Of course, the board does recognize that eventually management will stop monitoring an acquisition, even on a combined basis. If integration of the acquired business into the existing business is a key objective, management might stop monitoring the performance of an acquisition once the objectives around integration are complete. Nonetheless, the board does assume that management know how well an acquisition is performing for at least 2 full years after the year of the acquisition. The board is interested in hearing how much a barrier integration is. Does integration make it impossible to monitor subsequent performance, with the result that companies are not monitoring their acquisitions, as some stakeholders say? Or, as the board expect, are management still aware of how well an acquisition is performing in the early years? And if so, what information are they using? Does that information require management to make many assumptions? Slide 14 discusses 2 other concerns the board has heard from stakeholders about its preliminary views on disclosures of subsequent performance of acquisitions. The first is that some of this information might be commercially sensitive. Stakeholders have expressed concern that information about the objective of an acquisition or the progress in meeting those objectives might provide information to competitors that could disadvantage the company. In addition, some stakeholders told the board that disclosing information about the strategic rationale for an acquisition could lead to competitors being able to identify potential future targets, driving up the price the company has to pay to obtain those targets. In addition, some stakeholders have suggested that fears about commercial sensitivity might discourage companies from disclosing useful information about subsequent performance of acquisitions that they currently disclose in their management commentary. The board's preliminary view is that commercial sensitivity is not a sufficient reason not to disclose the information investors say they need to hold management to account. Some investors we asked about commercial sensitivity have said that companies often provide detailed information when they announce deals. This could be through hosting investor days or press releases to explain an acquisition. Investors are simply looking for companies to provide a follow-up to that information, which presumably isn't commercially sensitive, because companies were willing to disclose that information in those earlier materials. In addition, some investors have said that even if the information is commercially sensitive, then having to disclose this is really just a consequence of being listed and being able to use investors' capital to make those acquisitions. Investors say they should be able to hold management to account for those acquisition decisions. If stakeholders have concerns about commercial sensitivity, it'd be useful if they could identify what specific type of information that they're concerned about disclosing, and explain how disclosing that information could harm the company and investor interests. The other area of concern is that some stakeholders have questioned how auditable the information would be, and ultimately this is a question that's best answered by auditors. The board expects that the information would be verifiable. So the board thinks that an auditor would be able to confirm that the information disclosed is the information management are using internally, that the basis of preparation of the information is clear, and that the information faithfully represents what it purports to represent. Initial feedback from auditors suggests that they think the information should be auditable, but at an additional cost. So as Tom said earlier, the board's preliminary views also included some ideas for targeted improvements to existing disclosures, including IFRS 3. And these are summarized on slide 16. They include requiring disclosure of expected synergies, defined pension liabilities and debt assumed, as well as some changes to the actual and pro forma information disclosed by the acquiree. Perhaps the most interesting of these preliminary views are those about disclosures of synergies, and so I'll provide a bit more background on that preliminary view. IFRS 3 currently requires a company to qualitatively disclose information about factors that make up goodwill, including synergies. Investors have told us that this often results in companies providing a generic description that is not useful. Achieving synergies is often an important objective of an acquisition. Accordingly, where synergies make up a material component of goodwill, the board's preliminary view is that the company should disclose in the year of acquisition 4 things. So firstly, a description of the synergies expected from combining the operations of the acquired business with the company's business. Secondly, when the synergies are actually expected to be realized. Thirdly, the estimated amount or range of amounts of those synergies. And lastly, the estimated cost or indeed range of costs to achieve those synergies. This disclosure will be required only in the year of acquisition. However, if synergies are a key objective of the acquisition, it's likely that management might be monitoring the achievement of those synergies in order to determine the success of the acquisition. If that was the case, information about those synergies and the company's success in achieving them would be captured by the board's other preliminary views that we discussed earlier. Some stakeholders have said that companies do not make estimates of synergies when acquiring businesses. The board expects that companies do make such estimates where expected synergies are material in order to determine the price that they're actually willing to pay for a business. And therefore, if a company is not estimating synergies when it acquires the business, the board would like to understand how those companies are determining how much they're willing to pay for a business. Some stakeholders have expressed concerns that the information about expected synergies might be forward-looking and that it might be better placed in management commentary rather than in financial statements. And so I've already discussed some of the similar concerns to that on the information about subsequent performance of acquisitions. So I'll now hand back over to Tom. Final comments.
Okay, so I'm just to say thank you and then move on to questions, I believe. So thank you for listening to this webinar. There's additional information on the board's discussion paper that can be found using the link on this final slide. And we encourage you to comment on the board's discussion paper. As a reminder, the comment letter deadline is 31st of December 2020. And there are many questions in the discussion paper. However, respondents can choose to answer only those questions of interest to them. We'll now try and answer some of the questions that have come in from our audiences. And so, Craig, do you want to read off the first question and think about who?
Yeah, I mean,
which of us
the first question we have is that most of the proposed disclosure about the post-acquisition would cause companies to reveal commercially sensitive information, and that's forward-looking information to be disclosed. How have you advised on the audibility of those disclosures? And I guess we've kind of covered all of those topics during the webinar. So I don't know if there's anything you particularly wanted to add, Tom, to anything that I've said on those.
Well, yeah, I guess I'd make a couple of comments about the commercially sensitive. If you look at the disclosures that are often made when company announces or sends the merger to a vote, the requests that we're making here are not very different from what is typically disclosed in those documents, as we noted in the discussion and when we went through the slides. And again, also, there's even the timing issue is that these will be coming out with annual reports, so they're slightly dated. And we don't think that, in general, the degree of disclosure that we're asking for is so sensitive that a real competitor wouldn't already have a reasonable handle on what was happening.
Thanks, Tom. We don't currently have any other questions.
Yeah, that one also talked about future. That question had two things in it.
Yeah, forward-looking information. It also discussed that.
Yeah, and so I don't know. We may want to emphasize again that there is here an anchor, and that's the price paid. And as we said earlier, these are all targets that were linked to that price paid. So they're not forecasts per se, but they're information that was used to generate the price. Again, in that regard, they should be auditable, and then it simply asks you to go forward in time and check whether those assumptions, which would be turned into targets, actually come true in a reasonable way. So that link to the price is not therefore asking you to do a forecast. It's actually asking you to disclose what did you think about when you set this price.
Yeah, I think that's right. It's really just trying to set a level of success in the future that management would consider the performance to be a success and to justify the price that they've paid. I think it is quite important to link it to the price paid. Certainly, it doesn't look like we have any other questions, Tom.
No, so I don't know. What do we do if we don't have other questions?
I don't know if you want me to provide a bit of an overview about some of the things we've been hearing. That might be helpful.
Yeah, I think that would be really helpful, and maybe prompt a question or two if you provide some background, more additional background.
So I think generally what we've heard is that there's a recognition that this information probably isn't often provided to investors. And when I say the information, I do mean the subsequent performance part. So as Tom said, there is some disclosures about the strategic rationale and maybe the objectives that are sometimes found in investor presentations at the time of the acquisition. Interestingly, at the recent IFRS conference, we asked a series of polling questions when we were discussing this particular topic. And most people said that the information is available, so companies are internally monitoring the success of their acquisitions. And most people actually said that they agree that this information should be provided to investors. However, most people then went on to say that the information should be disclosed in management commentary. But then also when we asked whether that means that companies will get the information that they want, the majority of people said that they didn't think that would be the case. And so they thought that if the board doesn't require this information in financial statements, then that information will not actually be provided to investors. I see there's probably a recognition from stakeholders that we have spoken to, at least so far, that the board has tried to strike a reasonable balance between the costs and the information provided by using this management approach. There are some concerns about the use of the chief operating decision maker, in particular how it interacts with general materiality requirements. We've had a couple of people say that the CODM reviews very little information about the subsequent performance of acquisitions, but equally a few other preparers have told us that the CODM actually reviews a lot of information about perhaps even all or almost all acquisitions. The other areas of feedback probably mainly focus on the practical concerns about the information, and we've kind of covered them during the webinar, so things like the commercial sensitivity point, forward-looking information point, and the integration point. I'd say that's a very high-level summary of some of the things we've heard. But I see we still don't have any questions, so I think perhaps we just give anyone 10 more seconds to quickly type a question if you have any. Otherwise, we can probably close the webinar. I see we've got another question has arrived. So the question is, would companies disclose the reasons why they paid a certain price if that disclosure is commercially sensitive? For example, reason behind loss-making business acquisition. I mean, I would say in part they already have to quantitatively disclose some of that information, because applying IFRS 3 just now, they already do have to give some information about what goodwill is made up of. And that provides some information to try and justify the price, because obviously if there is goodwill, then there is a higher price paid than the amount of assets and liabilities that they've recognized. So I'd say there is already some information there. This perhaps might just be more detailed. Tom, I don't know if you have anything to add to that.
Yeah, and again, I'd come back, if you think about all the disclosures that are going on around there, the question is how commercially sensitive. At the time, entities normally put together some financial forecast justifying the price. There's often an independent advisor who comments on it. And so I think, given that we're talking about a small number of metrics that you're going to use to look, it's fairly obvious kind of what you're hoping to achieve in a merger, given all the evidence and the competitors are aware. So I think while there is some risk of commercially sensitive, it seems to me that is unlikely to be really serious for a disclosing company. And that's where what's much more important is that investors understand what's happening and that management can then be held to account.
Thanks, Tom. And we have one further question has arrived as well. So this person says that the board wants to add a requirement to disclose the operating cash flows in the pro forma and actual information in the year of acquisition. They want to know why not investing and financing cash flows also.
Well, the simple answer we've got is, in talking to our user stakeholders, the operating is the one that they're particularly interested in. That's the one that they are more inclined to use in attempting to forecast going forward.
Thanks, Tom. I think that's all the questions. Oh, no.
We got another one?
Yeah. The other one is, if the impairment model is kept, would the ISB revisit the possibility to allow for reversals of impairment to ease the pressure on the impairment test? does the board have evidence how users would interpret reversals and would preparers use them? I think I can answer probably that. We have heard this from some stakeholders that allowing reversals would mean that more companies are willing to recognize an impairment of goodwill in the first place. We did ask our CMAC and GPF consultative groups, so that's our investor and our preparer consultative groups, at their meeting last week or the week before. And I think generally the agreement between both of those groups was that this will, allowing reversals of goodwill impairments won't actually result in more impairments being recognised in the first place. They don't view that as a particularly helpful mechanism, and some of the preparers said that it would be costly to track that through the system. And I would say that the other reason is that the board currently forbids reversals of goodwill impairment because it's not possible to distinguish whether the increase in the recoverable amount of a CGU is the result of recovering some goodwill you've previously written off or the result of some internally generated goodwill. And so without further information about how you're able to distinguish between the two, then it's difficult to allow kind of reversals from a conceptual basis. Tom, I don't know if you have anything to add to that.
I think that's accurate, although we are getting some people who would like us to think about it again. So it's part of the project, I think.
Yeah. I think that looks like all of the questions we've had, so perhaps we can finish our webinar there.
Okay. So I guess it's up to me to thank you all for listening. Please follow the project on our website. Please, if you can, read the discussion paper and comment. We think there's potential for significant improvement with respect to these disclosures, and also the other issues, the goodwill question, are long-standing that people have strong views on, and we'd like to hear yours. So thank you very much.
Thank you.